Coming up today, S&P closes above 5,800 for the first time. JPMorgan says we've made a soft landing. The latest earnings data. Tesla disappoints Wall Street with Robotaxi. The latest from China. Good oil see $100 a barrel again. And why stocks could keep ripping up right until the election. It's been another great week, guys. Let's go. And welcome back, everybody, to the daily market review as we head into the weekend. S&P 500 just put in its fifth consecutive weekly close higher and made 5,800 for the first time, with another really bullish breadth of a day across the board. Stocks just don't seem to care about anything negative out there. Valuations, war in the Middle East, hurricanes, consumer sentiment, you name it doesn't care. And this is supposed to be the most volatile month of the year, especially in an election year, and especially coming into Q4 hot like we are right now. So the consensus out there was that we're going to get a big spike, which could still come in the second half of this month, as we're not quite made it to halfway yet. And option dealers are certainly keeping their implied volatilities bid, but the market is just grinding higher here. Seems like it's already on a predetermined path. You can see my sector trends table, pretty much green across the board. And just looking at my sector breadth table, we got a big bump up this week, pretty much across the board, with the weakest sectors now being staples, health, and utilities, all defensive sectors. Top three performing sectors overall: financials, industrials, and tech, with energy still the best performing sector in the short and medium term. 95% of energy stocks above the 50-day moving average. And even though the S&P traded up today, a bit over 0.5%, it was a Russell 2000 small caps clear standout winner, up over 2%. And stick with me today because I'll come back to the volatility markets later on, along with bond yields, which are still climbing higher, even though we got PPI inflation come in line as expected today, even a little on the soft side. We're getting a nice bounce back on Bitcoin. A lot of bullish seasonality coming into cryptos here. I'll also get you updated on gold. We're going to take a look at uranium. I'll let you know what to expect from China coming this weekend. I'll give you the latest on the banks, a few of which just reported today. Getting monster rips there. JPMorgan up over 4%. And of course, we'll touch on Tesla, which upset the market today. Even though a few of us, myself included, didn't think it was really warranted. So we'll take a look at whether this dip may get bought or is there good reason to worry. But first off, let's just acknowledge the strength of this stock market. Rallying up with the most dicey global macro backdrop. Now got the S&P 500 topping 50 trillion for the first time. That's now 50 times more than when the secular bull market began in 1982. It's up sixfold since it stood at 8 trillion at the end of 2008, the end of 1999, the last tech bubble, 12 trillion. During the depths of the 73-74 bear market, entire index was valued at around 500 billion. What a ways it's come. American stocks absolutely dominating the world. By some measures, 60% of the world's market cap. How much further does that have to run? Well, for the here and now, we're just getting more and more bullish signals. S&P 500 has just done 5 consecutive monthly closes higher. Looking back in history, the 29 times that's happened before quite often goes on to make 6, 7, even up to 11 consecutive months higher. And about 96% of the time, we're higher a year later, average gain of 10%. And so even though the stock market is at all-time highs, there's really a lack of enthusiasm out there from both small and large traders. I'm definitely seeing it all over the place. And of course, there's good reason. American stocks, by many measures, are definitely not cheap. And we can see that lack of participation in single stock option activity here in the dark blue line. It's actually well off those late 2021 peaks. Had a big meme stock craze, everyone loading into call options. Haven't really returned to those peaks yet. And we've still got many of those favorite stocks from back then, still well off highs. Many of them formed a stage 1 base, look to potentially go on to a stage 2 advance. But many investors are just not buying this rally. They're on the sidelines in cash. Some are unfortunately short. And just to give you a taste of some of the rhetoric out there that we're seeing across the financial community, and I pretty much see these posts every day. This one here, 2008 really broke capitalism in a way that nobody under 30 understands. And I think there's a big psychological hangover from the GFC. I traded all the way through it. It was a really daunting and scary time. S&P fell 55%. Financial stocks fell over 80, 90%. A lot of people were wiped out, big and large. Some people have just pretty much doubted the bull market ever since then. I had someone a few weeks back tell me the market's been in a bull trap since 2009. Apparently it's been a 15-year bull trap. According to this person, the stock market is now 100% underwritten by quantitative easing, and the next big crisis will be in sovereign debt. Entire countries will disappear. We also heard from this guy today. People will never believe anyone telling them the economic crash is coming until it's over. All these people sitting on million-dollar properties and fake profits from the Mag 7 are about to realize they were fooled, and it is never different this time. Again, somehow there seems to be rhetoric out there that it's just the Mag 7 that's leading this market. They've actually been lagging for about 6 months now. We've seen a broadening of breadth all around the world. A lot of indices pushing up to all-time highs, along with entire sectors as well. Nothing to do with tech. Another one, I have a strong belief we are within weeks, if not days, from a steep correction that will be a minimum 20%. Positioning and investor sentiment remains extreme bullish as yield curves begin to disinvert and the unemployment rate rises. This is how it happens, only time will tell. And so of course anything can happen in the market. Very well could be on the cusp of a 20% correction in a few days. But I've also been hearing this pretty regularly since 2009 as well. And whenever you hear someone say something's definitely going to happen, that just shows a lack of experience in the market, because no one knows for sure 100% what's going to happen. We're all sitting here speculating, talking about probabilities, past patterns, statistics, trends. Nobody, not even the billionaires, knows exactly what's going to happen, especially in the very short term as well. Another one that showed up in my feed today: a brutal economic storm is on the way. Stocks will be slaughtered and real estate will crater like it's 2008 all over again. Now, I understand the logic behind this rhetoric. Valuations, markets just keep seeming to grind higher and higher. You got to understand the flood of liquidity and currency out there. It inflates everything. It doesn't just disappear overnight. You got corporate buybacks at all-time highs, forward earnings expectations at all-time highs, the most supportive Fed we've ever seen, government spending off the charts. That's a lot to go against just because of one indicator is telling you things are stretched. And I think the reality is we're just seeing a lot of pain from the bears. Unfortunately, it's people that have been trying to short this market, and it looks like we may be moving into a bit of a short squeeze. Looking at some of the most shorted stocks here by short interest, the days to cover, which translate how many shares are short versus the average daily trading volume, the 14-day RSI, which is a measure of momentum in a stock, and the 10-day change in the stock price. And look at that, average 10-day change of 25% in this list of 40 top shorted stocks. And so that's probably why we're hearing a lot of people upset with this bull market, because there is plenty of people short out there. However, we're getting research and a bit of a narrative across the financial community that the case for a US economic no landing is stronger than ever. And so a no landing basically means the economy can keep growing, but we may see an uptick in inflation, so we don't really get that recession or stagflation, no economic growth with inflation. JPMorgan's taken it a step further and pretty much declaring victory. The US economy has made a soft landing. They just came in with earnings better than expected, even raising its forecasts of what it expects to earn this year. Saying results are consistent with a Goldilocks economic situation, suggests inflation will keep coming down and that the consumer is fine and remains in effect on strong footing. And I think they're referring to the top 30-40% of consumers probably make up the bulk of their profit. Similar tone from Wells Fargo as well, who also reported today. And there's a look at JPMorgan. Pretty healthy beat, 9.5% on EPS. Stock almost back to all-time highs. Same with Wells Fargo. Came in with a 10% EPS beat. Stock up over 5% on good volume, even helping regional banks put in a good day. Up 3.4% in KRE, pushing up to highs. But of course, we're still seeing cautious commentary from Jamie Dimon, saying geopolitical risks are surging, conditions are treacherous and getting worse, that they're closely monitoring the situation. And he's normally one to throw cold water on things. However, the market doesn't care about all that. All they really care about is earnings per share and what they expect earnings per share to be going forward. However, like I said, Wells Fargo are seeing pronounced stress among their lower income customers. Those that aren't earning six figures a year are still grappling with structurally high prices and interest rate, cost of service debt. And that's probably why we saw consumer sentiment coming in a little lower today. Still plenty of uncertainty out there. With the University of Michigan Consumer Sentiment Survey coming in 68.9, a little bit down from 70.1 in the prior month. Economists were expecting 71. Americans' expectations for overall inflation next year rose to 2.9%. I'm just looking at some data today from FactSet as we just kicked off Q3 earnings. Still really early days. Can't start drawing conclusions just yet. Only 6% of S&P 500 companies have reported. 79% reported positive EPS surprise. However, they've just updated their expectation. They're saying the S&P 500 will likely report earnings growth above 7% for Q3. Maybe another reason why the markets are rallying up today. The back of those hot results from JPMorgan and Wells Fargo. So by no means are corporate earnings contracting. They're actually expanding, broadening out, and that's set to continue next year. Of course, unless we get a recession, which is still a real possibility. Just to be clear, I'm not ruling that out. I would still give it at least 50% chance the US economy could contract next year, especially if the Fed changes its tune and goes back to being tighter. Because in my opinion, they're keeping things really loose for the here and now. And so just like in markets, data in the economy can change really quickly as well. However, we just don't have it for the here and now. But what markets didn't get excited about today was the much anticipated unveiling of the Robotaxi prototype by Tesla last night, and which Elon Musk came out and said would cost less than $30,000. That was surprising for me. Really talked up autonomy, the safety and economic benefits of it. He did acknowledge that he tends to overpromise on date, but he did say before 2027 they would be making these fully autonomous cars in high volume. They also demonstrated their Optimus robots, along with the Cybercab, dedicated Teslas, carry people around town, along with the Robovan, similar appearances to the Cybertruck, but Wall Street didn't seem all that pleased. So there was a lot of details absent about their Robotaxi network. Waymo's already got a head start over them, operating Robotaxis, San Francisco, LA, Phoenix. So it seems large investors were looking for more details on the actual execution. There's still a lot to prove, a lot of skepticism out there. Some even going as far to say it was a toothless Robotaxi. There's little evidence of feasibility, just a lot of skepticism. And so it appears we got that gap down. Tesla ended up finishing down 8.7%. Going into this, I was thinking there's real possibility the market could get excited by this. So it looks like I was wrong there. Just going down to a 5-minute chart here, looks like the dip was bought real early morning, just after we opened trading. Stock seemed to defend that level. It has traded up a bit, but still finished quite soft here. Also interesting to see today, shares in Robotaxi rivals Uber and Lyft actually rallied up off it. Investors seeming to make a bet that they could be the winners in the Robotaxi industry. No doubt Uber will be a big player. Got a big platform, the most installed users. They'll just license Robotaxi technology from whoever's got the best, or maybe even take out the company completely, integrate it. They did try and do some homegrown Robotaxi technology, but they gave up on it. Peers investors, for the here and now at least, have switched their focus to Uber, up over 10% today, and that's a brand new all-time high for Uber. Market cap 181 billion, and I still think this could be one of the biggest companies in the world within 5-10 years. Got a massive global platform, and just like Airbnb, they didn't really innovate or create any new technology. They're just a massive network with really good business characteristics. However, Lyft has fallen way behind on Uber, even though they rallied up almost 10% today too. It's like a lot of these hot stocks from back in 2021. They've fallen down. They've been pretty much basing for 2 years. We did seem to have a good push there on the daily chart. However, this is just one day, one candlestick. Can't get too carried away on that. In my opinion, even though yes, we could have got a little bit more detail, I think the market and a lot of analysts may have overreacted here in the short term. Just looking at some commentary on X here today. From one guy that was at the event last night, said he met an Apple employee at the Tesla event, and he told him Apple killed its autonomous car after figuring out what Tesla was building. And so it was strange to hear from Apple, I think it was earlier this year, saying they're stopping the Apple car, which apparently they'd been working on for over 7-8 years. Biggest company in the world with the most amount of cash couldn't pull it off. They threw in the towel. Didn't really give us a clear reason why. Also heard from someone else. As a Tesla enthusiast, I watched them reveal the most uplifting, world-changing tech which will realize insane future revenue and profit growth, but woke up the next morning to this because Elon can't quantify exactly how many trillions it will make. Wall Street is wrong. Another one. The markets won't get what happened last night at Tesla. I couldn't be more impressed. Musk laid out a bunch for the next decade. I've been to a lot of product launches and have never been to one like this. And it was quite impressive. At Warner Brother Studios, and I know there's an army of haters out there towards Tesla. There always has been, there always will be. But what other companies are putting on presentations like this? How elaborate it was. And potentially what a game changer it could be. Another one from Gene Munster, who was also at the event. Mega AI use cases are getting real. I can't stop thinking about my interaction with Optimus. One of the several jaw droppers was when I asked it to speak Spanish and it didn't miss a beat. The most important takeaway is this is just the start of Mega AI use cases. Another one. Optimus just poured a drink and didn't ask for a 25% tip on an iPad. I just put 10 more million into Tesla stock. This is coming from a VC who's had several successful exits on his resume. Another one, just invested another 2 million into Tesla. Musk showed the world the future of car automation, taxis, robots, and a chassis for what's probably a sub 30k automobile last night. So him too was quite impressed with what he saw. So we'll see whether Tesla, the stock price, can hold some recent support level, because you quite often see this in the market. Stock can gap down, kind of just holds and does a spinning doji, kind of fakes out a lot of people who just base all their decisions off the last candlestick. You quite often see it maybe dip down another day or two and then just zoom right back up. So that's what I'll be looking for here. But again, as a long-term believer, I don't really care what happens today or tomorrow. I'm more focused on the fundamentals and the revenue and the potential, not what day traders are doing with the stock for the here and now. But moving on, what is doing well is Nvidia, and the AI trade looks to be back on. Wall Street still bullish as ever on the stock, getting news that their latest Blackwell GPU chip is on schedule and is sold out for the next 12 months. They can't sell enough. They don't have a demand problem, they have a supply problem. Being able to make enough GPU chips, pretty much slap any price on them they want, and the most cashed up companies in the world are jumping over each other to get their hands on them, as there's an arms race for compute power. In fact, we had Nvidia CEO Jensen Huang ring the bell at the Nasdaq this morning, and another sign of the time. However, AI stocks pretty much been doing well for almost 2 years now, since early last year. As soon as Microsoft made its investment in GPT, really kicked things off. And so this AI boom could also be broadening out. Goldman Sachs says the next wave of investment in platform stocks like Microsoft and Datadog. Now, I'd hardly call Microsoft and Datadog an undiscovered area of the market. Microsoft, one of the most favorite stocks amongst investors for years now, and for good reason as well. They too dominate in the cloud, office, and a whole range of businesses actually. Where I think the puck could be going next is what powers AI. And we've already seen that with utilities having one of their best years ever. However, I think where it's going to next could be nuclear power, uranium, which big tech companies are actually just starting to turn to power all their data centers. And just about all of them either make investments or talking about making investments, looking on jobs boards. They're looking to hire nuclear specialists. No other energy source comes close to the power and efficiency of nuclear. And that's why we're seeing nuclear stocks heating up, looking at the technical price action as well. A few weeks back, we heard Microsoft partnering with 3 Mile Island to reopen after it was the site of America's worst nuclear accident all the way back in 1979. And just looking at the most popular uranium ETF traded out there, the Global X Uranium ETF, URA. Pretty good technical signs. We may have put a bottom in here in August and September. Found a double bottom on a bullish divergence. These big momentum thrusts up on volume, and we're just pushing up as well. Trend strength going back to blue. And just going out to a long-term monthly chart. This is still pretty much been basing for the last couple of years after it's fallen a lot. 2011, Fukushima accident in Japan. Whole world gave up on it. Then a decade later, starting to realize, hang on a second, it's not all that bad when you look at the data. Most other sources of energy have a way worse safety record. And so markets, governments, and companies are starting to come back around to it. And I believe this is only the beginning. And that's why in my stock picks portfolio, I recently added a position in the uranium sector. It's already up 22% after I just added it last month, and I plan on adding more in this sector, along with a few other secular trends in commodities, fintech, clean energy, China international stocks, AI cannabis. These are all secular trends I plan on staying invested in for many more years. And so if you'd like to follow my stock picks portfolio in real time, get all my weekly deep dive research into what stock I'm about to buy next, then click the link below this video, head on over to my website, clickcapital.io, and use coupon code PLTR to save 30% on a yearly plan. And that will expire this Sunday. So anybody who's been thinking of joining my stock pick service, now's the time to act. And you can follow my new investing account in real time, which is currently sitting at all-time highs today after having another good week. Well ahead of the S&P 500 since I started it in June, and I've gotten lots of great feedback from all my members. And so unlike other trading memberships out there, I don't just give vague trading ideas or alerts with no track record. Don't overload you with useless information as a disguise for providing value. We just get straight down to business, and I tell you what stock I'm buying, why I'm buying it, along with my insights and research on it. And I'm looking for stocks that can potentially offer big gain in under 3 years. So if you'd like to jump on board that, then head on over to clickcapital.io and sign up for a yearly plan before this Sunday. And moving on to an area probably more hated than the bull market in USA stocks has been the bottoming out of the Chinese stock market this year. Probably more skepticism on that than Tesla as well. But China could be gearing up for the big one this Saturday. Analysts expecting $283 billion worth of stimulus to be pledged. That's a pretty big number coming in. And the market will really be fixated on details. But just keep in mind, the market often acts like a manic depressant. Doesn't get what it wants, throws a tantrum, and of course many people jump on board that. However, you can be the one to give it the medicine it needs to calm down and go the other way. Buy the dip, take a calculated risk in a diversified portfolio, and potentially set up for an asymmetric risk to reward opportunity. And it's not just this big fiscal package. They've been feeding the markets a string of measures pretty much every day, loosening up their conditions across the board, really trying to get underneath their property and stock markets and uphold their 5% GDP growth target for this year. According to some research, Chinese stocks are poised for a huge run-up in the next year. Renaissance Macro CEO said perfect conditions are aligning for additional gains exceeding 50%, that the nation could have the perfect cocktail of ingredients to stage a monster run-up over the next year. And it's true, it's not just a fiscal stimulus. It's just like we saw with Tesla in 2020, 2021. The more people that doubt something, the more ammo and juice it just gives it to run. The more shorts that can be squeezed, and quite often, maximum profits are made when the maximum amount of people are wrong. However, according to this Chinese analyst that I follow, we shouldn't get our hopes up just yet. Expectations are still elevated going into this. Dip has been bought the last couple of days. We still need to see that big number. However, I'm not hanging all my hopes on what's about to happen on Saturday. My whole Chinese bullish thesis doesn't rest on one meeting, one data point, one candlestick. Got to kind of step back and look at the forest for the trees, because there is a lot of ammo out there. In fact, according to the Wall Street Journal, Chinese household savings are above $19 trillion. That's a huge amount of dry powder on the sideline, because Chinese consumers are fearful. They've been seeing their properties coming down. In a similar culture to the Japanese, they have a high savings rate and can be quite conservative. Just to compare that with the United States money market funds, which is also sitting at all-time highs, $6.5 trillion, an explosion in liquidity since COVID, which some say that's also still a lot of dry powder for the stock market, especially if the economy holds up and rates keep coming down. All these money market funds be earning a less yield may make its way back into the stock market. And I think a lot of people will be surprised on this data today posted by an American journalist in China who says if you want to stay relevant, you need to be in China. China's e-commerce market is bigger than the rest of the world combined. That's why I think there's a real possibility Alibaba could be bigger than Amazon one day, even though its market cap is a fraction of Amazon. And even though there's plenty of fear out there, short sellers, some hedge funds, fact is big money is starting to come back to China. Looking at equity flows here, where spiking up could be a changing narrative and big institutional investors around the world. And just the absolute trading frenzy. Over 2.2 trillion in turnover. Since they first kicked off all the big measures, September 24, less than a week after the Fed moved 50 basis points. And so the China 50 index has already done a 50% retracement of this move. 65% takes us down here. The market doesn't hear what it wants for right here and now on Saturday. They come out with a smaller fiscal package than expected, or even worse, no fiscal package. I'd expect a big dip down. However, I think that'll be another buy the dip opportunity, because they'll just get back underneath it again. But if not, if they fire off the big one, who knows, we may just gap up 10% or more come Monday morning. And FXI is actually holding up better than the underlying Chinese indice. Hasn't even touched the 50-day this whole time. But like I said, the lower we go, I think a lot of investors, myself included, will be right there to buy the dip. But of course, the volatility and risks remain, and Chinese shares are most definitely not for everybody. Just moving on to some economic data we got today. Producer price index holding steady for September, coming in a little softer in month over month, unchanged versus the 0.1% increase. And that's the prices producers, wholesalers are paying for stuff, which again, like I've been saying, I hadn't been expecting a bump up in inflation right here and now. The Fed only just got loose. Oil's just started ticking back up. All that stuff can take a few months to play out. But there's a look at a 10-year chart of producer prices in the year-over-year change. Still tracking on a 3 handle. Not really low compared to history. And the bond market didn't really react to it as well. Instead, we've got the 10-year yield actually trading up today. 2-year just took a little bit of a pause. And bond yields have pretty much done nothing but gone up ever since the Fed came out and loosened things. And this is causing mortgage rates to go back up as well. But we've still got Fed members saying rates are way above normal. Expect more cuts. Seems like the Fed is determined to get interest rates back down to a 2 handle. They don't seem really too bothered about the threat or risk of inflation returning. At least for not the here and now. Maybe next year they will. However, we've got some economists saying now the Fed shouldn't cut interest rates any more this year because of those risks. Just wait and see. Is the Fed too dovish? Was it just a big coincidence they did their most softest cut in history at their last meeting before the election? And what happens to inflation if oil keeps tracking higher? If we get more hurricanes, wars in the Middle East don't go away, potentially keep getting dialed up, the wealth effect from the stock market being an all-time high, is it possible oil could spike to $100? What happens if the Israelis do take out Iranian oil asset? What happens if Ukraine, along with NATO, do start attacking Russia directly inside their borders? What happens if we haven't seen the worst of geopolitics? It's going to be very hard for inflation to come back down to 2% anytime soon, in my opinion, because a lot of those upside risks remain in the market. Oil holding ground here above the 50-day. And like I showed you, energy stocks, now the best performing in the short and medium term. Likely why we're seeing gold stay bid, just doing a bit of a shallow pullback. Couldn't even touch the 50-day. But it's not all geopolitical tensions. A lot of commodity markets are in supply deficits, and a lot of them have got surging demand and forecast surging demand on the back of the AI boom. A lot of companies figuring out how to use silver, more and more so with electrifying the world. EVs. We've got silver demand outstripping supply for 3 straight years. And this is projected to continue, coming off the back of mass underinvestment, underproduction, new mines being discovered at lows, and silver appears to be holding its own as well, just below yearly high. Whilst we've still got agricultural commodities, which have been consolidating for the last 6 months, do look to be pushing up near the top of the range as well, to be set to break out. And all those commodities holding up, even though the dollar's bounced the last 2 weeks, just getting shy of 103. Got a few of my reversal signals firing off here, and this is in tandem with the bounce in bond yield, interest rate differential between America and other developed economies, going in America's favor the last couple of weeks. And just an interesting graphic for you guys today on the key minerals used in an electric vehicle. Surprised me to find out that the cells in an average lithium-ion battery with a 60 kilowatt hour capacity contained about 185 kilos of mineral, which for my American friends is about 400 or so pounds. Quite a lot. And this is why these are the commodities of the future, not just for EVs, but for a lot of renewable energy as well. Aluminium, nickel, copper, iron, cobalt, going to be a huge demand for all these commodities well into the future. And just moving on, America will be observing both Columbus Day and Indigenous Peoples Day on Monday. US stock market will be open, however the bond markets will be closed, most banks will not be open, and most post offices will be closed as well. And there's a look at the earnings calendar for next week, starting to dial it up. More of the blue chips coming out, more banks to start the week off on Tuesday. We're looking at Taiwan Semi on Thursday along with Netflix and a few others, but we still don't really get into the thick of it and mega cap tech until the end of this month, early next month as well. There's a look at the economic calendar for today. Canada's unemployment rate coming in a little better than expected, 6.5%. There's core PPI month over month coming in line as expected. Headline a little soft, consumer sentiment a little soft as well. Chinese inflation data coming tomorrow, along with their potentially big fiscal package. Looking out to next week, CPI inflation data from Canada come Tuesday. A few more Fed speakers. Inflation data for United Kingdom on Wednesday. Unemployment data from Australia as well. Inflation data Eurozone Thursday. Jobless claims as usual from the States. Retail sales expected to come in year over year 1.6%. And then Friday we finish out with some housing data and a few more Fed speakers. So no real big economic data prints from the States next week. We'll get to see how inflation's tracking around the world. Along with retail sales data, which we normally get a few key retailers reporting their earnings as well as we head into the busiest period of the year for the retail industry. The 6 weeks leading up to Christmas. Many retailers can do up to half of their yearly sales in that period. Just looking at the retail ETF, it's been consolidating pretty much all year, up and down. So we'll keep an eye on all that data for a read on the consumer. And Fed Fund futures pretty much pricing in a 25 basis point cut as a lock come next month, with the 2-year just holding ground at 396. TLT still pulling back, getting a little short-term oversold here. The VIX just pulling back a little bit here today, still holding on to 20, but we've still got pretty good contango curve in the volatility term structure. Really low up front, VIX 9-day 14. Option dealers not pricing in much volatility next week at all the way out to the VIX 6-month at 21. And I'd say the VIX 30 is going to stay bid going into the election, and that's why we can see option dealers really asking for a premium to sell options, even though the actual stock market is just not moving around a whole lot at the moment. Same deal on crude oil. Option dealers asking for hefty premiums to write insurance here, and we're getting a little bit of a bounce back, defending its 50-day. Still got Argentinian stocks, one of the best performing markets this year, along with China, pushing up to yearly highs. I've actually got 2 Argentinian stocks in my stock picks portfolio that are listed as ADRs in New York, so they just trade like normal stocks. Inflation expectations really zoomed back again this week. Industrial military complex also sitting at all-time highs. Apple still tracking sideways underneath its highs. Microsoft still trading heavy, and Nvidia pushing up towards all-time highs as well. Are we going to get a breakout next week? But on the back of that upgraded earnings forecast from FactSet, along with financials breaking out today, the wheels are in motion. And like I've been saying for the last couple of weeks, are we just going to do the opposite of what pretty much everyone's thinking and just grind higher straight into the election? Maybe get a little bit of volatility going into it, then afterwards, maybe we get some volatility. Let me know what your thoughts are on all this. You're welcome to drop a comment below this video. Thanks very much for sticking with Click Capital. Have a relaxing weekend, and I'll see you again on Monday night. Cheers.